Hey everyone, welcome back to Corporate Decoder, the place where we break down the SEC filings so you don't have to. And today it seems like we have a company that is about to get a little more complicated for investors because they are splitting their units into two separate tradable things. We have a new filing from 12C's investment company, the third. Now this is not a deep dive into their financials like a 10K or a 10Q, which usually contain pages and pages of numbers. Instead, this is a Form 8K, which is used to announce major events that shareholders should know about right away. Think of it like a special bulletin. If you are an investor or thinking about investing in 12Cs, this is important news. And before we dive in, if you find value in these decoded filings, make sure you're subscribed. We also have a Discord community linked in the description where we chat more about these companies and dive deeper. So what is the big news here on the 7th of January 2026, 12C's investment company third, or the company as they call it, announced a significant change for their investors. Starting the 9th of January 2026, holders of the units that were sold in their initial public offering will have the option to separate their units into two distinct parts: the Class A ordinary shares and the rights. This is a pretty big deal because these units were originally sold as a bundled package. Now, investors can choose to trade these components separately. Right now, if you own these units, they trade under the symbol TBLV on the Nasdaq Global Market. But after the 9th of January, the Class A ordinary shares will trade under the symbol TBLV and the rights will trade under the symbol TBLVLV. This separation allows investors to potentially tailor their holdings more precisely. Maybe an investor is very bullish on the company's future growth and wants to hold more shares, or perhaps they're more interested in the potential upside from the rights tied to a business combination. Let's break down what these parts actually are. The Class A ordinary shares are pretty straightforward. They represent ownership in the company. The par value is set at $0.0001 per S-share, which is a very nominal amount, typical for many publicly traded companies. This is the core part of your investment in the company's operations. Now, the rights are a bit more interesting. Each right entitles the holder to receive 1/10 or 1/10 of a Class A ordinary share upon the company successfully completing what they call an initial business combination. Think of these rights as a sort of option. They give you the potential to get more shares in the future, but only if the company achieves a specific goal, like merging with another company. It is like a bonus ticket that might pay off if the main event happens. This structure is common for special purpose acquisition companies, or SPACs, like 12C's Investments appears to be. The date of this announcement is the 7th of January 2026, and the separation begins on the 9th of January 2026. For investors who want to separate their units, they'll need to work with their brokers who will then contact Continental Stock Transfer and Trust Company, the company's transfer agent. It's not an automatic process, so investors need to be proactive if they want to trade the shares and rights separately. The fact that these are trading on the Nasdaq Global Market is also worth noting. It indicates a certain level of liquidity and market visibility for the company's securities. The company itself is registered in the Cayman Islands, which is common for these types of investment vehicles. The IRS employer identification number is 86,2,888,466, and the commission file number is 001-43011. These are just identifiers for regulatory purposes and don't tell us much about the company's performance or strategy. It's also important to note that 12C's investment company, the third, is identifying itself as an emerging growth company. This means they are eligible for certain regulatory accommodations and reduced reporting requirements. This is often the case for newer public companies. They have elected not to use the extended transition period for complying with new or revised financial accounting standards, which signals they are aiming for more immediate compliance with stricter accounting rules. The only exhibit attached to this filing is a press release dated the 7th of January 2026. This press release would likely contain more detailed information about the separation event, but the 8K filing itself summarizes the key points. Now, looking at this filing, we don't have any actual financial performance numbers here. This 8K is purely about a structural change in how the company's securities can be traded. This isn't about how well the company is doing in terms of revenue or profit, but rather how its investment units are being unbundled. However, this move to separate units into shares and warrants, or in this case shares and rights, is a common strategy for SPACs. It typically happens closer to the SPAC's deadline for finding a target company to merge with. By separating them, the market can value the underlying shares and the potential future value of the rights independently. Investors who are less confident about the SPAC finding a suitable merger might choose to sell their rights, while those who are optimistic might hold on to them. From a strategic standpoint, this gives 12C's investment company, the third, more flexibility. It allows for a clear evaluation of its core business versus the speculative potential embedded in the rights. It could also be a move to re-engage investors who might have been holding the bundled units passively. The main risk here, as with any SPAC, is the uncertainty of a business combination. If the company fails to find and complete a merger before its deadline, the rights might expire worthless and the value of the shares could significantly depreciate. The market's reaction to this separation will be a key indicator of investor sentiment regarding the company's prospects for a successful merger. In conclusion, 12C's investment company, the third, is making a structural change that allows its investors to trade units, shares, and rights separately. This provides more clarity and flexibility in how investors can engage with the company's securities. The success of this move will ultimately depend on the company's ability to execute a favorable business combination. What is your take on this unbundling of units? Do you think it is a positive move for investors? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more. And don't forget to join our Discord community linked in the description for more discussions like this. Thanks for watching, and I'll see you in the next one.